today, do the markets still have their head in the sand? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Now, I'd prepared quite a long show to record tonight, but late this evening, Damien Klassen from Nucleus Wealth published a brilliant paper, and I decided that I would devote a little time to walking through the points that he made, because there is a fundamental question we have to ask ourselves. What's happening to the markets? Is the market disconnected from reality, or is something else going on? And of course, it's a very critical question, because markets in the US have been reaching new highs, and even here in Australia, the markets are significantly up from where they were. So what's going on? And frankly, the question we have to ask ourselves is capitalism still living, or has it slid into something else? Well, Damien's article was titled Markets in the Eye of the Storm. Now, Damien, of course, is the head of investments at Nucleus Wealth, and I have to say this is one of the best articles I've read for a long time, so I just wanted to share the main points with you. I'll put a link to the original source item below, and by the way, this is being reproduced with permission. So he basically says that the investment markets are in the eye of the storm. The initial storm danger came as COVID-19 hit, decimating jobs and smashing demand. Governments and central banks ably stepped up to stem the damage, and investment markets calmed, but insolvencies and bankruptcies have only been delayed, not avoided, and the employment recovery is unlikely to be quick. The eye of the storm, he says, is not as safe as it appears. And in fact, there's a disconnect. And he went on to say that, at the risk of sounding like a broken record, the dynamic at the moment is as strange as ever been. He's spoken before about the best argument for buying stocks is the ironic case that capitalism is dead, and therefore buy equities. Disconcertingly, there continues to be signs that this is indeed the case. Governments around the world have made significant changes to bankruptcy and property eviction laws. When the crisis was expected, or hoped at least, to last for just a few months, this was good policy. There is no sense in shutting down companies due to short-term demand issues, or to kick people out of houses for short-term job losses. And of course, the changes have worked, as shown here from this chart, where the number of companies entering external administration has significantly dropped, and the change in US bankruptcies versus the prior year has also dropped, although up a little bit more now. And so he goes on to say, this is actually where the discontinuity lies. Australian bankruptcies in the June quarter were down 42%. The US is down around the same time. Europe is seeing similar effects. The number of unemployed is 50% higher than the start of the year in most countries. There's a clear tension which needs to be resolved, he says. It should be clear now that COVID-19 is not a 3-month blip, but rather a longer-term structural issue. Now it becomes a question of whether the cure actually turns into the problem. And he goes on to say that some jobs will never return. A Melbourne-based specialist delivery company has a niche delivering to hospitals and hotels. Revenues are down 75%, profits up 50%. Most of the profit increase is JobKeeper, but the owner has also torched middle management and worked out clients are just as happy with larger deliveries less often, rather than smaller deliveries more frequently. And so productivity is off the charts. And as revenues recover, the middle managers will not be getting their jobs back. And that's one of the things that I've been talking about, the structural unemployment, which is definitely now appearing to be a significant and long-term factor in the economy. Now, he goes on to say that capitalism has bankruptcies for a good reason. There is indeed a good reason for bankruptcies and evictions. When people or companies get into financial difficulty, bankruptcy gives them breathing space by cancelling interest and allowing them to resolve the problem. It forces them to reset their obligations and to come up with a plan to extricate themselves. And just as importantly, it alerts suppliers, employees, and other partners to the problem. The reason this is useful is that without bankruptcy, companies and people can simply use up credit with one supplier and then switch to another. If this is allowed to go on, then the suppliers start to go broke, and it creates a domino effect of economic issues. Evictions are similar. Say someone cannot afford a $1,000 a week rental or mortgage because of a job change, but could afford $600 a week in a different suburb. How long should they be allowed to stay in the $1,000 per week house? The longer that person is allowed to stay, the more likely it is that the landlord also goes into financial stress, or the bank has to reduce lending elsewhere, creating another domino effect. And bear in mind, he said, that for the most part, rental debts or interest is being accrued, the burden is getting larger, and the capital smaller. These are highly emotional issues, and in both cases, we absolutely do need a safety net, but a small debt can conceivably be paid off through a restructure. In contrast, larger debts become all but impossible to pay. So he says, perhaps we should be cruel to be kind. Say you have someone who is bankrupt owing $25,000 to a range of credit card providers, utilities and landlords. If they go bankrupt or are forced to sell their house, then it can be a devastating event. But if the jobs are not coming back quickly, then if you give that person 6 more months, then compounding interest and more bills might turn the amount into a much higher figure. And for the borrower, it is far crueler to be under 6 months or 12 months more emotional and financial stress. During this time, they go from a small debt to a far larger debt, while hoping for something will come along to fix the problem. Better to bring the issue to a head earlier. And I keep saying this, of course, in my presentations, because quite often we see households in mortgage stress who are caught hoping things will improve and actually don't take initiatives soon enough to be able to deal with their stress problems. So the amount of financial distress they get into is ever greater, and the amount of debt that they are saddled with at the end of the process is phenomenally larger. So sometimes early action is precisely the right action. He goes on to say, for debtors, an early resolution is much better, as each debtor has a lower exposure and might get paid out something. At high debt levels, individual debtors end up with almost nothing. So then he goes on to ask a broader question. How long can capitalism be suspended before it becomes a problem? And he said, there are 2 competing macroeconomic effects. We don't want bankruptcies to snowball into more job losses, into a housing market crash, into more defaults and so on. So by delaying the start, it creates a calm spot, the eye of the storm. But also, we don't want the lack of bankruptcies to mean that the over-indebted who aren't paying their bills start bringing down people who weren't over-indebted. This is the second half of the storm. And he goes on to say, governments were hoping for a short, sharp shutdown and recovery, or a cure or a vaccine. It didn't happen. Governments attempted to pull the first lever again and hope. The issue is that the second grows bigger every day. By pulling the first lever again, if we don't get a cure or vaccine, there is a much larger problem emerging. If the last 10 years have taught us anything, they've taught us that given a choice between taking a little short-term pain for a large amount of economic gain, or taking a short-term gain for large amounts of economic pain, the politicians would prefer to take option B way more often than more sober observers would prefer. The rolls are rolling off around the globe. My expectation, he said, is that we will create at least some sense of normalcy, but there are already countries extending provisions until the end of the year or beyond, which makes it difficult to assess when the eye of the storm will pass and the second half will begin. There is an alternative possibility that markets are now entirely dependent on central bank support, so economics and fundamentals no longer matter. We have a checklist of a dozen decisions that governments and central banks can make that will eventually suspend capitalism. A few of the items have already been checked off the list. The more that gets implemented, the closer we are to a genuinely new paradigm. But we do not believe this will be a likely outcome, he says. The steps taken must become increasingly radical. Effectively, central banks and governments bailing out and propping up most failing businesses, turning the world's capital markets into a herd of state-owned entities that will kill the village in order to save it. And he concluded by saying that they've changed their models to try and account for some of these variations, but you have to understand the limits of your models. The key to navigating as we exit the eye of the storm will be to not lose track of the principles of good investment whilst changing models enough to reflect that times are not normal. Given a toxic mix of low interest rates, volatility, and expensive markets, he said, investors will need to be significantly more nimble than in the past. To which I add, well, actually, this is the fundamental question about what's going to happen to the economies of many Western countries. Have we actually turned the corner away from capitalism? Are we going to find that central banks and governments continue to support big business, continue to put more money into the system in a hope of somehow putting off the day of reckoning? And the real question is, does the day of reckoning ever go away? Or does it get pushed out further and further into the future, creating more havoc in the process? And if you take house prices as an example, if you assume that they are overpriced and they will have to come back, then the more you push it out into the future, the bigger the bubble that's created, the bigger the crash that follows, and the less likely it is that we're going to escape from this in any semblance of order. So kudos to Damien. I think he called it out just right, and it is worth reflecting on what he said, because we are in a new normal, but I'm not sure that this normal is forever. And if it does blow up, then the bang is going to be a lot bigger. Maybe that's the reason to keep your head in the sand a bit longer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.